All right, today we are diving into a real head-scratcher from the world of retail. Imagine this. A company's profit takes a nosedive, but its stock price, it just explodes, soaring over 20% in a single day. Well, that's exactly what happened with Miniso, and we're going to get to the bottom of it. So, just look at these numbers. On the one hand, you've got the official report. Profit for the first half of the year is down, and not just a little bit, but almost 23%. Ouch. But then, on that exact same day, the stock market does the complete opposite. It doesn't just nudge up, it skyrockets by over 20%. So, what on earth is going on here?
You know, it's pretty clear that Wall Street and the headline writers were reading two completely different books. So let's play detective. We're going to dig in and figure out what investors saw that made them ignore the bad news and send that stock flying.
Okay, first things first. To crack this case, you've got to understand a fundamental rule of finance. Not all profit is created equal. And here's the absolute heart of the matter. Miniso actually gave us two different profit numbers. You've got the official one, the one that follows all the strict accounting rules, coming in at 906 million yuan. But they also showed an adjusted profit. And that number, it was almost 1.3 billion yuan, and get this, it was actually up 3%.
So, which number do you think investors paid attention to? You guessed it. They focused on that adjusted profit. Now, what is that? Well, think of it as a way to see how the company is really doing once you strip away all the, let's call it accounting noise. You know, the weird one-off stuff that has nothing to do with their main business of actually selling things in their stores.
So what was all this noise they stripped out? Well, it was a few big-ticket items. There was a loss from an investment they made in a totally separate supermarket chain. Then there was the interest they had to pay on the loans for that deal, plus some other financing costs. And here's the key thing. Literally none of that had anything to do with how well the actual Miniso stores were performing day to day.
And this really tells you something. The market is getting smarter. Investors these days, they know how to look past the surface-level stuff. They were sharp enough to say, okay, that's just some one-off strategic stuff, and instead, they focused right in on the real health of the core business.
Okay, so that explains why investors weren't panicking about the profit drop, but it doesn't explain the 20% party, right? The real reason for that massive stock surge, well, it was a huge signal that the business had finally hit a major turning point.
And that signal came from a really important metric called same-store sales growth. It's simple, really. It just looks at how sales are doing in stores that have been open for at least a year. And after being in the red, shrinking in the first quarter, it flipped to green. It was growing again in the second quarter. That, right there, was the turnaround signal everyone had been holding their breath for.
And you can't overstate how big of a deal this was. It tackled the #1 fear that investors had head-on, the idea that Miniso's home market in China had just hit a wall, that the growth was over. This little green bar proved that wasn't true. The core business wasn't just holding on, it was actually growing again.
All right, so the foundation in China is looking solid again. That gave investors the green light to get excited about what's next, and it turns out Miniso has some pretty powerful growth engines.
You can really think of Miniso's growth story as having three key parts. First, the recovery at home in China. Second, its massive overseas expansion. And third, this exciting new brand they have called TOY. So let's start with China. They're totally revitalizing their home market. The strategy's changed. It's not just about opening as many stores as possible anymore. Now it's about big stores, quality over quantity. They're opening these larger, more impressive flagship locations. And it's working. Just look at the new Shanghai store, a huge hit. And their newest stores are way more efficient. Okay, now let's talk about the overseas story, because this is where things get really explosive. We're talking nearly 70% revenue growth in North America alone in the first half of the year. I mean, wow. This isn't some little side hustle anymore. International growth has become the main engine driving this company forward. Now, of course, that kind of rapid expansion costs money. Miniso is making a really interesting choice here. They're opening more of these stores themselves, directly, instead of using franchise partners. Yeah, it's more expensive in the short term, but it's a long-term strategic bet. They get more control, and more importantly, they get to keep more of the profits down the line. And that brings us to the third growth engine, and this one is really cool. TOY. This is Miniso's trendy, high-growth toy brand, and it just got a huge stamp of approval from investors, with a new valuation of, wait for it, 10 billion Hong Kong dollars. The fact that this investment was led by a big global name is so important. Why? Because it's not just Miniso saying their toy brand is valuable anymore. It's a credible, outside expert putting a real number on it.
This basically validates the whole thing as a serious business and unlocks a ton of hidden value that was just sitting on Miniso's books.
So let's recap. We've got a stable core business and a few powerful growth engines firing away. So what's next for Miniso? Let's take a look at their big vision for the future and, of course, some of the bumps they might find in the road.
Their whole vision is to become the #1 IP design retail group in the world. So what does IP mean here? Think exclusive products, collaborations with artists, with famous brands, the kind of unique stuff you can only get at Miniso. And the goal here is massive. They want over half of all their sales to come from these IP products by 2028.
So, to sum up the bull case, the reasons for all this optimism, it really boils down to a few key things. They have a global growth model that's clearly working. Their business back home in China has stabilized and is on the upswing. They've got this super valuable top toy brand, and they're showing a strong commitment to giving cash back to their shareholders. But, we have to look at the other side of the coin too. There are definitely risks to keep an eye on. That supermarket investment is still losing money. The cost of going global so fast could put a squeeze on their profits. And at the end of the day, they're a retailer, which means they're always a bit vulnerable if the global economy slows down and people stop spending as much.
And all of this leaves us with a really interesting final thought. Miniso's strategy seems to be pointing towards a future where retail isn't just about selling stuff anymore. It's about creating and selling unique intellectual property, almost like an entertainment or design studio. So the big question is, are we watching the birth of a totally new kind of global retail giant? It's a fascinating story to follow.